This is what stocks do when war breaks out. And I don't mean that as a clickbait headline. I mean it as a genuine framework for understanding exactly what's unfolding in the market right now. Because if you're watching your portfolio bleed this week and you're wondering whether to panic, whether to sell, whether to run for cover, I want to give you something more valuable than an opinion. I want to give you 100 years of data, and I want to walk you through that data slowly and deliberately. Because the worst thing you can do right now is make a major financial decision based on fear, based on a headline, based on a futures number you saw on your phone at 10 o'clock on a Sunday night. That's not a strategy, that's a reaction, and reactions in markets almost always cost you money. But before we dive in, the only thing I ask in return for all the work that goes into making a video like this is that you hit that like button and don't forget to subscribe. Every time you do that, YouTube pushes this video out to more people, which helps us prepare more people for what's happening. The United States is currently carrying more than $38 trillion in debt, and the truth is, by every historical precedent, the current system should already be under extreme stress and really collapsing at this point. Yet, the USA continues operating as if nothing's wrong, and financial markets just keep hitting all-time highs while the real economy is deteriorating. And in times like these, the best way to secure and maintain your retirement is to maintain a balanced portfolio that can ride through this economic chaos. With that in mind, I've developed a list of the best 6 stocks to own in 2026 that you can download for free at stockscommunity.com/free. If you're actively managing your stock portfolio, head over to stockscommunity.com/freedom to book your free 15-minute strategy call and chat about your stock portfolio and your goals. And there's one stock I want you to keep in the back of your mind as we go through all this. It's an oil company headquartered in Denver, Colorado. It's not overextended like some of the names that have already gone vertical this week. It's not US oil up 19% in a single session. It's something quieter, something that money's rotating into right now beneath the surface while everyone else is chasing the obvious trade. And we're going to talk about exactly why in the back half of this video. So stay with me all the way to the end, because that single idea might be the most actionable thing you take away from everything we cover today. Now let's talk about what's actually happening, because the scale of what has unfolded in the last 72 hours is genuinely historic, and you need to understand the full picture before you can make any kind of rational decision about what to do with your money. $85 billion was wiped from the stock market on Friday alone. $3 trillion has been wiped from global markets since this conflict escalated into its current form. The February jobs report came in at negative 92,000 jobs against an expectation of positive 50,000. As it's not a miss, it's a collapse, 142,000 jobs in the wrong direction relative to what economists were modeling. U.S. crude oil just posted its biggest weekly gain on a record dating all the way back to 1983. Iran's rejected ceasefire negotiations and publicly stated it's ready for a 6-month war. The U.S. and Israel struck Iranian oil infrastructure for the first time, footage that was genuinely alarming to watch as oil spilled from depots into streets, entered sewers, caught fire, with Iranian officials warning of black oily rain and the possibility of acid rain across the country. The U.S. Embassy in Saudi Arabia ordered the evacuation of all non-emergency personnel and government employee family members. The first such evacuation order we've seen in this conflict, which tells you something about how the people with the best intelligence on the ground are reading the situation. And over the weekend, futures opened down hard as markets began processing the selection of a new supreme leader in Iran, believed to be more extreme than his predecessor, with Donald Trump publicly calling this selection unacceptable. Meanwhile, oil opened up 19% on Sunday, sitting at $108 a barrel after JP Morgan had told us just days earlier that most of the damage to oil prices was already in. As always, the largest institutions in the world were wrong at exactly the worst possible moment. There are also reports of plans involving American and Israeli special forces to potentially seize Iran's stockpile of highly enriched uranium, with Trump suggesting boots on the ground could happen at a later stage for, quote, a very good reason. The largest U.S. defense companies met with the administration on Friday and agreed to quadruple production of weaponry. Water desalination plants are being targeted on both sides of this conflict, which is deeply escalatory and brings civilian infrastructure directly into the line of fire. In Kuwait, 90% of drinking water comes from desalination. In Saudi Arabia, 70%. This is not a contained military operation. This has the potential to reshape supply chains, food systems, and energy markets in ways that would ripple through every single portfolio on Earth. So the question you're asking right now is the same question every investor has asked at every major geopolitical inflection point for the last 100 years. What do I do with my money? And I want to answer that question the only honest way I know how, which is with actual historical data. Because here's the thing that nobody tells you when markets are in free fall. Your gut is the worst investment advisor you've ever hired. Your gut says sell everything, go to cash, wait until this blows over. History says something very different, and history has a much better track record than your gut. Let me walk you through this carefully. When Russia invaded Ukraine in February of 2022, the stock market moved sideways for a couple of days, had a brief sell-off, and then fully recovered to new highs within about a month. Yes, the market went significantly lower after that, but that had almost everything to do with the historic money printing of 2020 and 2021 coming back to haunt the economy through inflation, and almost nothing to do with what was happening between Russia and Ukraine. The timelines overlapped, but the cause was not the war. When Israel and Palestine escalated into open conflict in October of 2023, the market dipped briefly and then powered to one of the strongest bull markets we had seen in years, all the way through early 2025. So that's two recent and very clear examples, but let's go back much further because the data set that really matters here spans 80 years of major geopolitical events, and what it shows is something most people never stop long enough to actually look at. The attack on Pearl Harbor produced the worst total drawdown of any event on this list, nearly 20% from top to bottom, and yet just 1 year later, the market was up over 11%. Iraq's invasion of Kuwait in 1990 produced a drawdown of almost 17%, which felt catastrophic at the time, just as this feels catastrophic right now. 1 year later, up 14%. You go down the list, and you see the same pattern repeat itself across decades and across wildly different geopolitical contexts. North Korea invading South Korea, the Suez Crisis, the Cuban Missile Crisis, the Kennedy assassination, the Gulf War, September 11th, which is probably the closest emotional analog most Americans have to a moment where the future felt genuinely uncertain. September 11th saw the market recover in about 18 days. And what you find when you look at all these events together is that the average number of days it takes for the market to fully recover across all of them is 41 days. 41. And remember, that average is being pulled significantly higher by the two big outliers, Pearl Harbor at 307 days and Iraq's invasion of Kuwait at 189 days. Strip those two extreme outliers out, and you're looking at a median recovery time that's well under 30 days. 6 months after the average major geopolitical event, the S&P 500 is up 2.5%. 1 year later, up over 2% on average. And before you dismiss those as small numbers, understand that those averages include the absolute worst outcomes in modern financial history. The Yom Kippur War in 1973, where the market was down 41% a year later. Germany invading France, down 18. The oil embargo, down 35. Bear Stearns collapsing, down 41. Those catastrophic outcomes are dragging that average down dramatically, and the market was still positive 2% on average 1 year later across all of them. That's a remarkable finding. Now here's the single most important variable in all of this data, and I want you to burn this into your brain because it's the framework that should be guiding every decision you make about your portfolio in the weeks and months ahead. The biggest determinant of whether the market goes up or down in the year following a major geopolitical event is not the severity of the conflict, it's not the number of countries involved, it's not even the price of oil. It's whether or not the economy enters a recession at the same time. When there was no recession 3 months after these events, the market was up over 3%. 6 months later, up 6%. 1 year later, up 9%. When there was a recession happening simultaneously, 3 months later, the market was down 6%. 6 months later, still down 6%. 1 year later, down 11 to 12%. That's a swing of 20 percentage points in 1 year outcomes depending on a single variable, not the war, the recession. And that brings us to right now because that question is genuinely live and genuinely unresolved, and nobody on earth can answer it with certainty at this moment. We saw negative 92,000 jobs in February. Jobless claims have been slowly creeping higher all year. Jack Dorsey's note to block employees about AI-driven labor disruption is just one data point in a broader pattern of rising unemployment that's not yet showing up clearly in headline numbers, but is showing up in the underlying trend. Retail sales are already down an annualized basis over the last 3 months per Goldman Sachs. Goldman estimates underlying job growth is running at about 37,000 per month, well below the 60 to 70,000 monthly level needed just to keep pace with the workforce growth. The yield curve is uninverted, which is historically one of the most accurate recession predictors we have. And now you layer on top of that an oil shock that's potentially just beginning and that has a direct transmission mechanism into inflation, into consumer spending, into corporate margins, and into the Federal Reserve's ability to respond. Because here's what the oil move actually means for the real economy beyond the obvious. It's not just the price at the pump going up 50 cents. When oil prices rise this fast and this aggressively, a cascade begins. Nations start hoarding reserves. China and India have already started doing this in the early stages of this conflict. And that behavior pushes energy prices even higher as available supply contracts. A third of global fertilizer production comes from the Middle East, which means food prices spike not because of a bad harvest, but because of the input costs of growing food at all. And suddenly you have an inflation problem that's not demand driven and is therefore not something the Fed can solve by raising or cutting rates. The Bank of England already said this week that it's not confident it can continue to look past yet another energy shock, which is significant because it signals a shift away from the transitory inflation framing that central banks have leaned on repeatedly since 2020. If the Federal Reserve coordinates that same view, rate cuts come off the table entirely for the rest of 2026, and the market loses the one safety net it's been counting on to catch any major sell-off. The volatility index is not just elevated right now, it's in backwardation, meaning near-term uncertainty is being priced as more dangerous than long-term uncertainty. That's structurally bearish in the short term. The last time the gap between individual stock volatility and index level volatility was this wide was 2008, which is not a comparison anyone should make lightly. Credit spreads that looked like they were tightening on Wednesday blew completely back out on Friday. Market breadth has deteriorated sharply, with less than half the stocks in the S&P 500 currently trading above their 50-day moving average. Prior market leaders in semiconductors, memory data centers, fiber optics, and financial stocks are rolling over violently. These are not orderly pullbacks. These are sharp, fast, aggressive breaks of key technical levels that tell you institutional money is repositioning, not just taking profits. The weekly SPY chart produced its first close below the multi-month balance range. The NASDAQ is pressing against a critical 595 support level. It's not yet confirmed to breaking, which is actually creating an interesting divergence from the S&P worth watching. The small cap IWM, which had been quietly setting up what looked like a constructive bull flag just weeks ago, had its entire pattern invalidated in 3 days. And the sector leadership that had been sustaining this market, names like SanDisk and memory, Oracle and data centers, the entire semiconductor complex through the SMH is now sitting below declining moving averages with no clean technical reason to expect an immediate recovery. And before we go further, if you're actively managing your portfolio right now and you want to talk through what all this means for your specific situation, I'm currently offering a completely free 15-minute training on how I spot stocks before they go up at stockscommunity.com. And at the end of the call, if you choose to join a call at stockscommunity.com/freedom, I'll let you know what we've got going on in the community and how certain members went on to make thousands of dollars in single days. The link is in the description below. And if you want the broader list of where I see the best opportunities right now, regardless, go grab my best 6 stocks to own in 2026 completely free at stockscommunity.com/free. So what does history actually say to do? Here's what it gets interesting, because even with everything I just described, even with the recession risk, even with the oil shock, even with the Fed in an impossible position between fighting inflation and supporting a weakening labor market, the historical data does not say run. It says be selective. It says be precise. It says understand which sectors benefit from exactly the environment being created right now. And then it says find the names within those sectors that have not already gone parabolic, because the money that moves early into an obvious trade almost always gets washed out before the real sustained move happens. Look at what's already gone vertical. USO, the broad oil ETF, up 19% in a single weekend session. Certain defense names like Lockheed Martin have already made their initial move. Airlines are in free fall as jet fuel costs have doubled since this conflict began. Semiconductor darlings are being unwound aggressively. The early rotation out of growth and into defense and energy has already happened in the most visible and most crowded names. But smart money does not chase the names that already ran. Smart money looks for where the rotation's still early, still quiet, still in the process of setting up before the crowd arrives and before the easy risk reward disappears. And that brings me to the stock I mentioned at the very top of this video, the one I asked you to keep in the back of your mind. There is an oil company based in Denver, Colorado called Ovintiv, ticker symbol OVV, and it's one of the most interesting and quietly compelling setups in the energy space right now for a very specific set of reasons. It's not extended. At a time when oil-related assets have been going absolutely vertical, OVV has not made that parabolic move yet. It's not had the kind of straight line gap higher that leaves you buying into a rubber band stretched well beyond any reasonable entry point. It's a North American focused oil and gas producer with operations spanning the Permian Basin in Texas, the Anadarko Basin in Oklahoma, and the Montney Formation in Canada, which gives it geographic diversification across some of the most productive and cost-efficient oil-producing regions in the Western Hemisphere. It's structurally positioned to benefit from exactly the kind of sustained oil price elevation we're seeing right now. Not the one-day spike that gets immediately faded, but the prolonged elevated price environment that comes from Middle East supply disruption, from nations hoarding reserves, from global inflation expectations being repriced higher across asset classes. When oil stays elevated for weeks and months, producers with a low break-even cost and strong operational leverage to the oil price generate dramatically more cash flow than their stock prices typically reflect at the beginning of the move. That's the opportunity in a name like OVV, and critically, it sits at a technical level where the structure is not yet resolved to the upside. It's not broken out and then pulled back 50%, like some of the names that got crowded too fast in the initial wave of defense and energy buying this week. The relative strength of OVV compared to something like USO, which is already extended and already has an enormous amount of speculative positioning baked in, is genuinely meaningful from a risk-reward standpoint. When the broad market is selling off everything indiscriminately, and when institutional money needs somewhere to rotate that's not correlated to the tech wreck, that's not dependent on rate cuts materializing, and that does not require the economy to be broadly healthy to generate earnings, they look for exactly this profile, a producer with real assets, real cash flow, leverage to a commodity that's going higher for fundamental reasons that have nothing to do with speculation, and a chart that's not already priced in the entire move. And OVV generates cash flow, so when oil is elevated, that's regardless of what the Federal Reserve decides to do about rates, it makes cash. It doesn't need AI capital expenditure to keep flowing. It doesn't need the labor market to recover. It needs one thing: oil to stay above the cost of production, which at current prices is an enormous margin of safety. So this is not a call to chase oil at any price. It's not a call to ignore risk. There's always a scenario where a ceasefire happens faster than anyone expects and oil gives back half its gains in a week. That risk is real and you have to size positions accordingly. But it is a call to notice what the market's quietly doing beneath the surface while everyone's focused on the loudest headlines. Smart rotation is not into USO at a 19% weekly gain where you're buying after the fact. It's into the producers that have room to run precisely because they have not run yet. If you want to talk through how a name like this fits into your specific portfolio situation and your specific risk tolerance, remember, you can book that free 15-minute call at stockscommunity.com/freedom and we can look at it together. If you already know you want the broader list, go grab the free download at stockscommunity.com/free. Quick side note, if you haven't seen what the inside of my 6-figure strategy calls in Stocks Community are like, click the link in the second part of the description. It's a rare inside look at my one-to-one stock coaching. I have daily calls like this all the time with beginner, intermediate, and advanced 6 to 7-figure investors that just ask me questions specifically about stocks. If you click that link, you'll get a little taste of what that looks like. If you'd like more material like that with charts, I actually have a whole bunch of it completely for free if you go to the videos tab and sort by oldest videos first. And if you want to be part of this tomorrow, we run these every single weekday. You can also apply to work with me down below if you're ready to take your stock investing to the next level and if you qualify for the $25 trial. If you go to stockscommunity.com/training, you'll get my free private 10-minute training called former engineer, shares 3 key lessons from his Ivy League experience, which walks through my 3-step Sunday trading protocol. So what did I miss here? What would you push back on? Let me know in the comments below. And if you're managing your portfolio independently and you want to know how I spot stocks before they go up, book that completely free call at stockscommunity.com/freedom, where I can better understand your long-term goals and your approach to the market. If I think we're a fit, I'll extend an invitation to my community where I teach my students how to find the best stocks, spending just 10 minutes in front of their computers a day. The link is in the description below. And again, if you've got a portfolio going, you want to make sure you're in the best stocks in the market right now, download the best stocks to own. stockscommunity.com/free. Finally, if you found this information valuable, smash that like button, subscribe to the channel, and share this with somebody who needs to hear it. Because the people who prepare themselves and stay one step ahead of the everyday person will always come out ahead in the long run. Thank you for watching, and I will see you in the next one.